Let's kick right into this explainer with a staggering number, $8.9 billion. That is the sheer asset scale of Business First Bank shares, which you probably know as B1 Bank. Now, they just grabbed some major headlines with a seriously impressive Q2 earnings beat of 71 cents per share. I mean, they blew past expectations, making them look like this unstoppable powerhouse regional bank that's just firing on all cylinders. But as we know in the financial sector, the headline is rarely the whole story. So we're going to strip away all that heavy banking jargon today to see what's actually driving B1 Bank's engine right now in mid-2026. We need to look right past those glossy press releases to understand the real mechanics of their growth, the hidden risks lurking on their balance sheet, and figure out if the stock's recent run is actually justified. Here's our quick roadmap. We'll look at the regional banking contender, their triumphs and expansions, some red flags under the hood, strategic plays and innovation, and finally, valuation and insider moves. All right, starting with part one, the regional banking contender and B1 Bank's strategic footprint. So they operate primarily across Louisiana and Texas. But here's the thing, they aren't trying to be this massive, faceless megabank. Instead, they rely heavily on a highly specialized advisor-led model. They target businesses, professionals, and high-net-worth individuals. And honestly, this business strategy is their competitive moat. By focusing on relationship banking instead of just treating you like a transaction number, they intimately know the local economies. They can offer completely bespoke financial structuring and way faster decision-making than the big guys even could. And when you embed yourself that deeply into a client's business operations, you create incredibly high switching costs. Basically, clients just don't want to leave, which gives B1 Bank a really sticky, low-cost deposit base. Moving right along to part two, triumphs and expansions, or what we are calling the growth facade. A huge chunk of their recent growth narrative really centers on their acquisition of Progressive Bancorp. They seamlessly closed this deal on January 1st, 2026, and boom, it immediately added 9 banking centers to their footprint. Plus, it injected a whopping $774 million in total assets onto their balance sheet. This successfully bulked them up and drove a super strong Q2 core net income of $23.3 million. And that brings us to how the financial media is covering this. You see quotes exactly like this one talking about strong earnings, capital growth, and robust liquidity. It paints this flawless picture of a regional bank successfully consolidating its market and expanding its reach. But is that actually the whole picture? Let's dig a little deeper. Which brings us to Section 3, Red Flags Under the Hood. Let's peek past the M&A. Because when you actually lift the hood and strip away the assets they literally just bought, the organic health of the bank tells a pretty different story. Check this out. In Q1 of 2026, total loans look like they jumped a massive 8%. Sounds great, right? But hold on a second. When you subtract the $589.7 million in loans they acquired from Progressive, the core organic engine actually contracted. Their organic commercial and real estate loans shrank by over $100 million. So the core business wasn't actually growing. It was stalling out. Now, to understand these widening cracks, we quickly need to get on the same page about non-performing loans, or NPLs. Just as a refresher, these are simply loans where borrowers have stopped making their scheduled payments. Basically, loans going bad. And right here is your major red flag. Their NPL ratio accelerated to 1.53%. To put that into perspective, that is more than double the 0.69% we saw just a year prior. Now, management has come out and noted these are previously identified commercial real estate issues that they are targeting for resolution, but still, this troubling multi-quarter spike in bad loans leaves very little room for error. They are absolutely going to need to resolve these by the end of the year if they want to protect their future earnings from some pretty severe credit costs. It's not all doom and gloom under the hood, though. Fortunately, management showed some serious pricing power. Despite a really volatile rate environment, they successfully lowered their overall cost of funds by 19 basis points. So they essentially cut the interest they pay out down to 2.45%. This proactive defense really helped cushion the blow of their falling loan yields, effectively defending their overall profit margins. All right, moving into Section 4, Strategic Plays and Innovation, Future-Proofing the Bank. The thing is, B1 Bank isn't just sitting still taking these headwinds on the chin. They're aggressively future-proofing. First up is their brand new partnership with Covecta to deploy agentic AI. And no, this isn't just another corporate buzzword. They are moving way beyond those simple, clunky customer service chatbots. They're actually integrating AI directly into their deposit and loan workflows to automate all that repeatable middle office stuff. This is a very real, tangible way they plan to reduce manual overhead and drive some serious improvements in their operating efficiency.
And right alongside the tech upgrades, they're basically raiding talent to kickstart that stalled organic growth. I mean, they literally poached a Houston regional president from Veritex along with a team of key producers. Plus, they're leaning heavily into fee-based, capital-efficient revenue streams. They're expanding their SBA lending, growing the corresponding banking unit, and they even recently scooped up American Planning Corporation to bolster their wealth management advisory services. It's a very clear, deliberate pivot toward diversifying their income. Finally, let's hit Section 5, Valuation and Insider Moves. What is the true price tag here? So we've looked at the shiny acquisitions and we've seen the organic struggles. So what does the market actually think B1 Bank is worth? Well, currently trading at a price-to-earnings ratio of 11.43, the stock sits at a pretty noticeable discount compared to the broader finance sector's average, which hovers way up around 29.18. So from a purely traditional valuation standpoint, it seems like the market is already pricing in some of those exact risks we just talked about. Now, for the income-focused observers out there, they do offer an annual dividend of 60 cents per share, which yields about 1.87%. What's really notable about this is that the dividend is backed by 7 consecutive years of dividend growth. That's a strong signal. It shows management has some serious confidence in their internal capital generation and the overall health of their balance sheet over the long term. But, you guys, here is a metric you absolutely cannot ignore. After a 23% year-to-date run in the stock price, insiders are aggressively taking their chips off the table. Over a recent 3-month window, insiders bought roughly $47,000 in stock. Okay, fine. But they sold over $2.2 million. Let that sink in. Insiders sold 4,700% more stock than they bought. When the people inside the building are selling at that kind of volume, yeah, that's a data point that demands your attention. So as we wrap up this explainer, you really have to ask yourself the ultimate question. Are their strategic expansions, these invigorated AI integrations, and the flashy new talent acquisitions going to be enough to outrun the hidden deterioration we found in their core loan portfolio? Look, management is definitely making all the right structural moves, for sure, but the clock is loudly ticking on those non-performing commercial real estate loans. You're definitely going to want to keep a close eye on their next quarter to see exactly which side of this equation wins out.